get started, Tommy?
Yeah, I was going to say, let's get started. So, welcome everyone. Thank you for joining us here at the Carrington for our Q1 2021 markets update webinar. My name is Tommy. I assist Mo on the research side in the business and as well as help on the planning side as well. So, how the webinar is going to work is we're going to talk through 2021 so far and what we've seen in financial markets. We're going to explore kind of what life will be like beyond COVID-19 and how we believe it will play out in financial markets as well. And Mo's also going to give you his thoughts for 2021 moving forward. As well as this, we're going to explore the topic of ESG, which we believe is really important at the moment and is becoming more and more prevalent in the world today. So I will pass you over to Mo. Just before I do that, I'll just remind you guys, if you have any questions throughout the webinar, there is a Q&A function box at the bottom, or it might be at the top of your screen, which you can just ask a question and we will look to answer them after Mo's given his update. So Mo, I will pass it over to you.
Thank you very much. Hello, everyone. Good afternoon. And thank you very much for taking the time to join us today. I'm just going to share my screen with you. There we go. Right. So, as Tommy mentioned, the topics for today are 2021 so far and what we have seen in the markets, what potentially could be life beyond COVID and what we expect to happen. We'll look at the environmental, social and governance factors, otherwise known as ESG, which we've touched on in our previous webinars. We'll move into thoughts for 2021 and then end with a summary. So if we look at 2021 so far, the first quarter has been really a quarter of two halves. The first half being relatively good for markets, calm, and a continuation of last year where we saw some of the themes that had done quite well continuing to do well up until about the first or second week of February. What we saw after that was a very sharp rise in government bond yields. Now, this is quite normal to see these yields rising when the economic outlook is improving. And there was a wide expectation for bond yields to rise throughout this year as economies began to open up and their recoveries took hold. However, no one anticipated the manner in which it came, which was a very, very sharp move. And if we look at the last sort of 20 years or so, this is up there in the sort of four largest moves we've seen ever in a quarter. So quite an unusual event. But then having said that, the past year has been sort of very unusual anyway. What that meant was quite a lot of volatility filtering through into the markets. Because when you see those sorts of moves, it does create quite a lot of nervousness in the market. So certain parts of the equities came under a lot of pressure. Some of the bond markets in particular came under a lot of pressure. Certain geographies and certain regions also came under pressure, whilst others did okay. So if we look at the specifics as far as the sectors go, in short, anything that had done well over the last year or so and potentially beyond, such as technology, came under pressure. And the areas that hadn't done well, such as we call them the cyclicals, but they're otherwise known as the economically sensitive sectors, such as the banks, the retailers, the airlines, staged a recovery and did quite well. The UK actually and Europe did very well geographically speaking. They tend to do well when the sort of global economy is picking up and you get this sort of rising yield environment. And in particular, the UK smaller company areas did very, very well. So we actually have exposure across our portfolios to UK smaller companies via a mixture of funds and ETFs, and they have done exceptionally well. Some of our funds at the moment are up about 16 or 17%. And on the sort of economically sensitive parts, we do also have exposure via an ETF across all of our portfolios. and its job really is to do well in these sorts of environments, which it has done. And so some areas of the portfolios did very well. And so what we did right at the end of the quarter is that we rebalanced the portfolios. And what that means is we took profits on those that did well and took the position sizes back to the original weightings. So essentially locking in the profits. The move to reduce bonds, which is something we highlighted in our previous webinar in our summary, has worked. And the reason why we were concerned about bonds was two main reasons. First being that we did not expect very good returns from bonds this year. And secondly, we believe that they are losing their diversification benefits we have seen for quite a long period of time now. But more recently, I think the case is that they are losing that sort of benefit in the portfolios. And so we've already been active in reducing our bond exposure in the portfolios, and we were more aggressive on that late January, early February, following our last webinar that we talked about. Sorry, that's and what we did was increased our exposure to hedge funds specifically, and that move has worked very well for us. So the hedge funds have all done well through the quarter. They've all profited from the environment that we've seen, and a lot of the bond markets have come under pressure. Maybe worth just quickly adding that we did hold on to some of our bond funds for very specific reasons, and they subsequently went on to actually did okay and delivered positive returns. And we also slightly adjusted our exposure where we had, for example, inflation protection, and we felt that there was a better product out there compared to what we had previously. And so we had already been buying that product last year, and we added to it in January and February. And thankfully that product actually went on to do very well. So it was up about 2.5% during the quarter, whereas the previous product that we owned actually ended negative. So generally speaking, that the moves that we've done around the bond markets and hedge funds have worked very well. So if we just quickly talk about COVID, I mean, maybe it's a little early, but the vaccines are well underway in terms of the rollout. Yes, there are some concerns emerging with specific ones, such as Johnson and AstraZeneca, but I think the direction of travel is that we are heading to a mass vaccination environment, and perhaps it's a little early, but maybe we can start to think about life beyond COVID, certainly as far as financial markets are concerned. I guess one risk to that is clearly there are certain variants around at the moment, such as the South African variant that is raising some concern. But I think so far the data that's coming out, the various vaccine manufacturers suggesting that they have that strain under control as well. Clearly there may be a new one that emerges that we have not seen yet, but at the moment it looks like we can start to think of life beyond. Now clearly that the normal that will emerge is probably going to be something different to what we're used to, and an example I gave in my recent investment update over email was a concert that went ahead in Barcelona where there were 5,000 attendees. All had to undergo rapid testing before entering the arena, and all had to wear face masks. And I think that's probably going to be life for some time to come, but it will it'll be a combination of some sort of normality returning alongside additional protective measures. So therefore, as far as the economic outlook is concerned, what we have seen, as I mentioned, is a pickup in growth, and the US, for example, is expected to grow 6% this year, which is far higher than the average, and probably 4% next year. But beyond that, our expectations are for growth to eventually normalize back to the pre-pandemic levels of around 2 to 3%. therefore, as far as our portfolios go, at the moment, we're not looking to take any action at all. We're going to wait and see how we emerge from this. But I think it will bode well for the funds that we have introduced in the portfolio, specifically the thematic areas. And so at the moment, no actions, but we're watching. But I think we're probably well positioned for what will emerge post-COVID. Some of you would have seen us talk about the ESG area previously, but just to sort of briefly touch on this again. ESG, otherwise known as environmental, social, and corporate governance factors, have clearly become a major talking point in the world, not only in financial markets, due to a combination of social and corporate acknowledgement in trying to live in a more sustainable world. So as far as the fund management industry goes, traditionally they've really only focused on the G, which is the governance. So that's looking at the behavior of management teams and how they allocate capital and the sort of return that they're getting on that capital. But more recently, they've had to start focusing on the E and the S, the environmental social factors, so that they get a more sort of complete picture of that company. And what that's led to is a sort of natural tilt towards very specific sectors such as technology, healthcare, and renewable energy. So these particular areas have done exceptionally well over the past few years. There were some concerns building that, the amount of money flowing that direction and how quickly some of those assets were rising, that valuations were perhaps looking a little stretched. This quarter, those specific areas have come under a bit of pressure, as we've seen, and as I mentioned, the bond yields rising. There have been some profit taking, and therefore valuations, I would say, are now more attractive than they were at the start of the quarter. However, this is a long-term, very, very long-term theme, I believe. We're looking at several decades of a shift in the corporate world. And so we have a portfolio to capture this called the Carrington Sustainable Growth Portfolio. We launched this about 2 years ago, which was relatively early compared to our peer group. It has been our best performing portfolio of that time frame, and I expect it to continue doing well over the long term. Moving on to our thoughts for 2021. So we've seen this sort of great rotation, as some people have called it, from the areas that have done well, as I mentioned, to the areas that haven't done as well. And I think that a lot of that, or if not all of it, has been priced in already. So again, I gave an example in my investment update, which was Marks and Spencer rising over 80% since the end of last year. But the reality is that Marks and Spencer and most other retailers are going to remain under pressure. And so this whole sort of rotation idea is likely to subside, in my view, particularly as growth starts to normalize. However, I don't think that it means that very specific sectors are going to do well and others won't moving forward. I think there's probably more of a chance that you get a more broad-based rally where multiple sectors are performing well in their own right, post this whole sort of rotation period that we're seeing at the moment. And again, I think that the long-term structural themes that we've talked about several times in the past will begin to reassert themselves as we sort of normalize, the economic growth sort of normalizes back to where it was pre the pandemic. As far as what we're up to at Carrington, again, no real plans to make any adjustments at the moment. We're comfortable with the exposures that we have, and as far as the equities are concerned and the thematic areas that we have, I'm very comfortable to continue with those, because some of those are very, very long-term themes. In summary, if we just sort of zoom out a little bit, clearly we've focused a lot on the quarter and what's happened, volatility, but if you just zoom out, we are in a bull market and therefore remain positive on equities for the remainder of the year. Given that we have how we emerge from COVID remains unclear, we have the potential for further volatility, but the general direction of travel we believe will continue to be upwards. On the bond front, we think that given the way they have reacted so far this year, there is the potential for them to recover some of their losses and potentially even deliver positive returns. But we are going to maintain a low exposure. And the main reason for that is because we, at the moment, we're having a huge amount of stimulus injected into into our economies from the various central banks, such as the US Federal Reserve. And at some stage, I mean, the magnitude is absolutely enormous. We're talking about post-World War II levels of stimulus, far eclipsing the sort of global financial crisis, what we saw back then. So clearly, at some stage, the central banks will have to begin taking their foot off the pedal and even potentially unwinding, which I don't think will happen, but they will at least have to stop supplying such large quantities of money into the system. So whenever that happens, it may be the end of this year, maybe next year, but whenever it does, there will be quite a nasty reaction in the bond markets as well as some equity markets. And so for diversification reasons, we don't know when that's going to happen, and therefore we are better off outside of the bond markets. As I've just mentioned, we are continuing to focus on alternative sources of diversification, specifically hedge funds. We already have very good exposures to a number of different funds, and we are looking to expand that periodically. So yeah, positioning, I think we're going to maintain generally as we are, so a very good exposure to equities and different sources of diversification, I think, to what our peer group are exposed to and what we have done historically. That moves me on to Q&A. So please feel free to ask questions. Tommy will read them out for me, and I'll try my best to answer them.
Yeah, sure. Pretty well. Thank you for that, Mo. It was really great to hear your thoughts. And we've got a few questions actually on different topics you've spoken about. So start just with one concerning COVID-19. Obviously, we see there's a lot of news flow that comes out about potential vaccines and their efficacy, etc. And just wondering what sectors are most affected by the negative news flow. The news of these vaccines perhaps aren't as effective as we first thought.
It will be the economically sensitive areas. So, for example, the retailers, the airlines, hotel groups, anything like that that are effectively tied to the economy are going to come under pressure. So any negative news will basically mean that the economic growth will come under pressure, and therefore those sectors will begin to struggle, as we saw last year.
Mm-hmm. And would it also reflect in the sense that more growthier companies would outperform on that sort of news?
Yeah, so the areas such as cloud computing and those that benefit from you being at home or spending more time at home will clearly do well. Online retail, mobile payments, all those sorts of things will do well.
Sure. Okay. We've got a couple of questions on ESG as well, what you spoke about. Firstly, could you give us some examples of some of the themes that sit within the sustainable portfolio?
Yeah. So one area that in particular is, and I mentioned this earlier, renewable energy. I think that features very strongly throughout the portfolio, probably for obvious reasons, as we move away from our sort of dependence on oil and increase our dependence on solar and wind and other forms of energy. So I think that's a very prominent area. And another area that features very prominently is healthcare, unsurprisingly. So specifically, there are stocks such as companies that manufacture diabetes, glucose monitors for diabetes patients, but with a sort of cutting edge technology that requires little intervention and it's almost sort of automated, self-automated. Those are sort of companies that we have in portfolio. So the two main areas of renewable energy and healthcare feature most prominently.
Sure. And actually on that, just we actually have a sustainable portfolio presentation. So if you did want to find out more information about that portfolio specifically, you can get in touch with us and we can send that to you. And that has, that kind of dives deeper into the kind of inner workings of the portfolio, the funds, and some of the underlying companies as well, because there are some good companies doing some really great things out there. Another question on ESG then is, how will we know when, obviously because ESG has been very popular the last year or so, how will we know when those investments have been overbought and those companies have been overbought? And is there a chance that the kind of ESG, the companies that are perhaps ESG unfriendly or aren't seen in good light, is there a chance that those will could be bought and overperform?
We've actually already seen that in this quarter. So let's say the oil majors, the large energy companies, have done exceptionally well because the oil price has been rising quite dramatically during the quarter. So yes, you can see that, and at the moment we have definitely seen that in the past couple of months. But this is that's a short-term basis. If you think of it on a slightly longer term, the reality is that our dependence on oil, for example, is at the moment robust, but will eventually decline. The uptake of we've set very ambitious targets in the UK for the adoption of electric vehicles by 2030, and I wouldn't be surprised that many other areas of the world will have a similar approach. That probably is a bit too aggressive, but the direction of travel over the long term is that that's where we're going, and so our dependence on oil will definitely decrease. When things are overbought, clearly that's very difficult, and there was perhaps an argument for that at the start of this year. However, maybe one other thing to bear in mind is that as this area evolves, an increasing number of companies are kind of falling in line. And therefore, the sort of opportunity set for this area and the managers that invest in this area is growing all the time. And eventually, I think what you will find is that the vast majority of corporations out there will be aligned with ESG metrics, and the vast majority of funds that we invest in will be invested. I mean, it won't even be a talking point. It will just be everyone is just aligned with ESG principles. Clearly, that's a long way off, and we're probably talking at least 10 years plus. But yeah, over the long term, I think that this trend is very much going to continue. But clearly, along the way, you're going to have some volatility.
And because ESG as a framework is sort of in its infancy, a thing that comes up a lot is this idea of greenwashing, and perhaps some funds companies aren't perhaps as green as they say they are. How do you combat that when looking at funds specifically?
So what we have done, clearly this is a big sort of area of conversation about greenwashing and some companies trying to pull over your eyes. What we have done as far as the fund management industry goes, because clearly, given that there's a lot of money chasing this particular area at the moment, and there'll be an even larger amount of money chasing it in the years ahead. Lots of asset managers have all of a sudden brought ESG funds to the market and have said that they have been investing in ESG for however many years, when previously you had no idea that actually was happening. So even in the industry, you're seeing this. So what we've done is we've tried to partner with fund groups where there actually is factual evidence of them investing in this area over the long term, and there are a number of funds out there that have been doing that, and they are the funds that we have specifically targeted and partnered with. So yeah, without going on for the next hour of this, that's probably enough to say on that.
Yeah, sure. No, it's an important topic, and as you say, you could talk for hours on it. So just we've just got one more question, going back to bond yields just shortly. We obviously saw you spoke about the rapid increase in bond yields, and how that caused a lot of market volatility. Do you, if bond yields increased to levels we saw earlier on in the quarter, do you think that will lead to additional market volatility?
It all depends on the manner in which we get there. If it is a very sharp move higher again, as we have seen, yes, that would lead to market volatility. If it's a more gradual path, which we've seen over the past few years, where at one stage, I believe it was in 2018 and 19, where bond yields, let's say the US 10-year Treasury, went above 3%, but it got there in quite a sort of staggered way, and it didn't get there. It wasn't too quick before it got there. So if we saw a very gradual move higher in bond yields, then that can be absorbed in the markets, and that's absolutely fine. But if we see another sharp move, then yeah, that will lead to.
Okay. We've just got another question as well on inflation and how that will impact the markets, and what are your thoughts there?
Again, it depends on how it manifests itself. So if we see steadily rising inflation, again, that will lead to steadily rising bond yields, and therefore the markets can absorb that and have time to adjust. If it's a very sort of sharp pickup and a very material rise in inflation, that again will lead to a very sharp pickup in bond yields, and therefore could lead to some volatility in the market. So again, depends on how we get there, but a gradual path upwards can be absorbed.
Mm-hmm. Sure. And just circling around again back to ESG. Based on what you said, would you be kind of suggesting to look for those companies that perhaps aren't prevalent in the ESG space yet, but have the potential to grow into it and develop their ESG credentials? And as well as that, should we be avoiding the companies that are sort of the ESG darlings, so to speak?
So we do actually have some funds that have an approach where they have something called the ESG leaders, and then they have the ESG. I think they call them some people call them the laggards, but others call them the improvers. So there's a sort of mix in the fund where you have those that are already at the forefront of their industry as far as ESG is concerned, and then others that fund manager has identified as those that are on the right track and have the potential to get there at some point in the future. So I would say a number of our funds have that approach, and therefore there is a degree of diversification within them. It's not that they're just fully exposed to the darlings. Right?
Yeah, sure. Okay, well, I think that's all the questions we have today. If anyone has any other questions, you can always get in touch with us and send myself or Mo an email, and we'll answer them as quickly as possible. But I'd just like to say thank you for joining us today, and I hope you guys got some useful information out of this. And I know, Mo, it's always great to hear you speak and share your thoughts.
Great. Thank you very much, everyone.
Brilliant. Thanks, guys.
Take care. All the best.